Happy Thursday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Thursday, December 1st, 2022. Happy official start of the holiday season. And if you think it starts a little bit earlier, well, that's what makes a market. But now our Christmas tree is up, and looking forward to that. Big day this morning in terms of the economic release spotlight, highlighted by the October PCE data out of the U.S. economy. Something we've been talking about for quite a while now that I think is starting to slowly make its way across investor consensus is the fact that the U.S. economy is booming on a coincident to lagging indicator basis. So let's just go down run down the rap sheet here. PCE headline PCE, so total personal consumption expenditures, roughly 70% of the U.S. economy accelerated 240 basis points to 4.7% on a 3-month annualized rate of change basis. That's the highest print we've seen since October 21. That's more than double the pre-COVID trend. Real goods PCE accelerated 590 basis points to 7.3% on a 3-month annualized basis. That's the fastest print we've seen since May of last year. Way more than, it's like several orders of magnitude faster than the pre-COVID trend. And then lastly, services consumption, which has continued to be, which had been leading PCE higher and continues to accelerated 50 basis points to 3.3% on a 3-month annualized basis. That's the fastest print we've seen since May of this year. Turning our attention to inflation. So we got a dovish surprise in core PCE this morning. If you look at it on a month-over-month annualized rate of change basis, both headline and core PCE slowed pretty meaningfully on those basis. But again, Powell said, reiterated, various members of the FOMC have consistently reiterated that 1 month does not make a trend as it relates to their reaction function. They're looking to see a string of a trend of disinflation data that is, consistent with their mandate on a 3-month annualized basis, which is exactly what Powell highlighted a couple of FOMCs ago. So focusing on the 3-month annualized, ignoring the month-over-month downside surprise, which, by the way, the market is having a very tepid response to. That might be an indicator if you're paying attention. You look at the 3-month annualized rates of change for these inflation measures. Headline PCE accelerated 180 basis points to 3.8% on a 3-month annualized basis. That's the fastest print we've seen since August, and the sharpest acceleration we've seen since July of 2020, coming out of COVID. And then on core PCE, which is their preferred inflation metric, accelerated 60 basis points to 4.9% on a 3-month annualized basis. That's the highest print we've seen since August. And oh, by the way, 4.9% on a 3-month annualized basis is 290 basis points higher than the Fed's 2% average inflation target. And so unless they are willing to abandon that average inflation target, there's a lot of hay to bale, and the market may have gotten over its skis with respect to pricing in the 5% terminal Fed funds rate, and B, the timing of the pause pivot in March. We may start to see some of those things elongate themselves or extend themselves higher and further out into the future, to the extent that the inflation data on a trending basis continues to look like the coincident and lagging indicator growth data on a trending basis. Again, if the economy is booming on a coincident lagging indicator basis, it's very hard for inflation to break down on a trending basis. And this is something we continue to pound the table on at 42 Macro in terms of our published research. We got our December 22 macro scouting report coming out tomorrow afternoon. So definitely make sure you make some time to review that over this weekend. If you're a subscriber, if you're not a subscriber, best of luck. Anyway, getting to my long, low dashboard, global macro, starting with global macro. So we're starting to get to some real signal here. As you could see, just looking at the range view, there's a lot of stuff that's overbought, a lot of stuff that's oversold. Dollar's been bearish from a short-term and medium-term price momentum basis, finally getting towards the lower boundary, the trading range there. So, and not only is the lower boundary trading range is actually sloping upward. So that's something you should be aware of in terms of trying to chase. If you're feeling FOMO today, if you got a whiff of those 0 DTE calls yesterday, and it's like smelling salt, and you want to go chase year-end Santa Claus rally, I would be very careful about that, considering where the dollar is in terms of its probable range. Gold, that's been bullish on both a short and medium-term price momentum basis, very clearly overbought here in terms of the longbow trading range. So it'll be a good spot to be shorting gold. This has been a mistake on ours in the 42 macro portfolio construction. Rare glimpse of what a specific trade that we make, but it is what it is. Like I said, I tweeted this morning. Look, if you look at the positioning data, CFTC data, you just scan FinTwit for 15 seconds, 99% of the world is being squeezed, getting their face absolutely ripped off in recent months. And so, I happen to be proud that I'm one of the few people providing thought leadership from the perspective of a bear that's being getting squeezed. A lot of investors are providing thought leadership from the perspective of people who don't have positions on and aren't really helping you manage risk, even though they're getting squeezed behind the scenes. And I don't think anybody learns from that. I don't think it's. I think it's quite frankly, it's disingenuous when people talk and don't acknowledge the mistakes that they're making. And because one of the things we really truly believe in here at 42 Macro is that you get two things when you invest. You either make money or you get smarter. You never do both with the trade. And so with some of these trades that we made mistakes on, and really the month of November was a really brutal month. In terms of those mistakes, we're making them out loud in front of all of our subscribers, in front of the whole world to see, so that we can learn from those mistakes, improve our process, and set ourselves up to achieve our investment objectives at a faster and better clip going forward. So very proud. Look, I hate losing. I hate losing money. It wasn't the worst month in the world, but I tend to take things quite personally. But anyway, I'm just happy to really be to have a platform to learn out loud and get better in the context of not many people being willing to admit their mistakes, and really the lack of accountability is something that I don't find particularly exciting to deal with in our industry. But anyway, sorry for the rant. Getting back to the S&P, so that's been bullish from a short and medium term perspective. Getting towards the upper boundary of the range, got 100 or 4100-ish on the upside there. Why not just tag it just so we can get it over with and short more stocks here. Bearish VIX again towards the lower boundary of the range. 1906 is a mirage, that we talked about that a couple of days ago. 20 tends to be the downside in a bear market. Again, we still believe we're in a bear market. You don't have 5% up days in the NASDAQ, 6-7% up days going back to the October CPI report. In bull markets, those things don't happen in bull markets, by the way. Russ 2000 has been neutral in terms of its short-term price momentum, bullish from a medium-term perspective. That is also overbought in terms of its longbow trading range. So a lot of actionable signals today. Not every day is there a major actionable signal from a global macro perspective in terms of dollar and VIX being oversold and S&P, Bitcoin, et cetera, being overbought. But this is one of those days. Bitcoin's been bearish on both the short and medium-term perspective. Longbow's telling you Bitcoin's overbought here. So a lot of alpha this morning. We'll see. A lot of ex-ante prospective alpha. We'll find out in a few weeks if these signals are actually accurate. But again, we don't wake up every morning expecting to be wrong. That's a loser's mentality. There are no losers here. You might lose money on a few trades, but there's no consistent losing here. We're actually having a reasonably good year. I mean, I don't like being down. I think we're down. I checked my PA last night. It was down 2.6% year to date. Hate the fact that it's down. I hate losing money, but again, down 2.6 in the context of, S&P down, 15, 20%, Bitcoin down, down 50, 60%, bonds down 25, 30%. I'll take down 2.6% because, oh, by the way, that's outperforming the global hedge fund index. So this nerdy fat guy is outperforming the average hedge fund. I'm very proud of that. Anyway, Shanghai Composite, bullish from a short-term momentum perspective, bearish from a medium-term perspective, getting towards the upper boundary of the range. And then lastly, crude oil. That's been bearish from both the short and medium-term perspective in the middle of the range there. Let's just take a look at that. Crude oil looks like it no longer wants to kind of trade down, really starting to rally. We made we made a very prescient, timely crowding call on this most recent around the horn in terms of crude oil. So congrats if you took advantage of that on the long side, crowding long call. And then lastly, getting to our free daily alpha tab, where we sort 300 ETFs, all representing individual factor exposures, by the odds tab to give you a sense of what's most overbought, most oversold, to trying to generate some actionable trading signals for you today. And guess what? There are many, a lot of things. The number one thing at the top of the list is SPY, S&P 500, in terms of what most overbought this morning. So, just kind of, that's an indication. You should be aware of that. Is there anything oversold? I'm guessing it's stuff like the dollar. Let's see. Tailware Simplify, our friends over at Simplify, their Tailware strategy ETFs oversold. So maybe if you're thinking about, kind of a Santa Claus delivering a lump of coal this Christmas, or even spilling over into the early part of next year, which I happen to think, if we are right on our November CPI, net liquidity is going to be spilling over in a really negative way to the early start of next year. So I wouldn't necessarily be too focused on the end of December for any sort of negative market response to the upcoming data from a net liquidity perspective. And then a lot of sort of echoing what I've said in the global macro tab, a lot of inverse ETFs are oversold here. So some good opportunities to take advantage of that. So anyway, this is my Longbow dashboard. You guys can all log in and create your own dashboards. It's a very affordable program that allows you, again, I think this is one of the most powerful tools I've seen in my 14-year career in the industry. I have a Bloomberg, and the Bloomberg doesn't do all this for you. The Bloomberg gives you all the data to do all this stuff, but it doesn't do all this for you. What's the other one people use? Retail investors use Trading View. If you think you can manage risk with technical indicators all the time, I mean, good. I think there are some people who do a really good job with technical indicators, but by and large, I mean, I talked about this with Andy Constant, former Brevin Howard, Bridgewater guy. He says, nobody serious on the buy side uses technical indicators that at best, or so a lot of folks do use things like the mark indicators. That's probably the most relevant technical indicator on the buy side. But generally speaking, if you're looking at 200-day moving averages and stuff like that, and putting lines on charts and stuff like this, that's not going to cut it. So highly recommend partnering with a platform like Longbow or a platform like ours if you need some help managing risk, because obviously it's been a very, very difficult year. Irrespective of how crappy of a month of November I had, I still think we did a great job of managing risk this year, if not as good a job as we'd like to. But again, we got 31 days in December. Let's party. Cheers.